It is a huge day. First, yesterday, I got in my full portfolio, like at 99% invested. I couldn't even put on the last one. Now, that means we need to take care of business, right? When your money's in the market, your money's at risk. Never let your market go on, or never let your money go unattended here. Okay, it is always at risk in the market. Second, this is the biggest lesson we're going to have probably in the entirety of the class. It involves also 3 videos that go along with the lesson, and we need to make trades. So we have way too much to do here in Outlier University. So you don't have to click the button now.
Are you ready? Let's go!
Respect is earned. Respect is never given.
That is right. Welcome to Outlier University. I'm going to teach you everything that I know about trading. Now listen, you guys here in class, you're going to be changing your lives and all future generations from this point forward. Joe knows. And
Wow, Chris. Wow.
Yeah, told you. I told you. Joe, didn't I tell you trading's meant to be effortless? Didn't I tell you that?
Yeah, but you told me it wasn't exciting. Today it was pretty exciting.
Exciting in a good way. Most people's trading is not exciting in a good way. Yeah. This is what trading's supposed to feel like. It's supposed to be like you open your broker and you see so much green you can't believe it. Right? And then when you have reds and you hit your exit signals, you just bounce them out. And you keep your greens until you get the exit signals for those. That's how it's done. So without any further delay, because we have way too much to do today, let's go ahead and start on the lesson. Let me introduce myself. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And we're getting into lesson 11 today, advanced options trading concepts. And I'm telling you, it is going to be ultra advanced today. Very, very, very advanced today. So be sure you have pen and paper. JC's camera popped up, but he's not there. Hopefully his camera didn't
No, I'm
accidentally.
here.
Oh, he's here. Okay. Good to see you, JC.
Nice to see you
JC,
guys.
today is going to be the biggest lesson we've ever had ever.
Great.
So let's get into it. So first slide on the deck here, leverage. What is leverage? Let me ask you guys, someone in the audience here, someone in class, tell me what you would consider leverage is. Don't read my notes. Go ahead, Dave.
I'm gonna jump in here because inside the class last night, we were having a discussion about how much stock we were controlling with the options. The rough math that I used was 10%. So I invested 10% of the net value of the stock that I now control. So 10-to-1 leverage is basically what we were able to accomplish on the options trades we all put on yesterday.
Isn't that cool, right? That's something Larry Height taught me. He's like, Chris, you can get a stock for 10 cents on the dollar. Like, what do you mean, Larry? Teach me your magical wizardry ways. And so that's why I do it this way. That's why I teach you guys to do it this way. Now, with that, it can cut both ways, right? You can lose more than you would on a stock, but you can also make tremendously more than you can on a stock. And we're going to be going through all that today, right? So leverage allows you to control a large amount of stock, like what Dave was talking about, with only a small amount of capital. But understand the gains on the leverage can be outsized, and so can the losses. But if you understand how to use it correctly, you can make unbelievable amounts of money. I know Joe is sitting over there with a big smile on his face because he was sharing with me some screenshots, and he's feeling that today, the unbelievable amounts of money. So I'm super happy for Joe. Now, what would you guys consider the golden rule of leverage? Let's go with anybody want to volunteer? Oh, go ahead, Joe.
Do your best to only let it affect you in the direction you want it to go. Like buying a call instead of selling a call or selling a put.
That's a super good answer. Let's see. Paul, what would you say the golden rule of leverage is? Caught him off guard. He wasn't even paying attention. And he's muted.
Sorry. I'm here. I didn't know there was a golden rule of leverage.
Well, what would you think the golden rule of leverage is then?
Don't over leverage yourself.
That's a great
Don't
answer
trade too big of a position.
Absolutely. So what I think the golden rule of leverage is, never put yourself in a situation where you can lose more than you can win. Never put yourself in a situation where the losses can be greater than the wins, not even once. Okay. Now let's break down what that looks like. So this is the call option we talked about in the last class, right? If I'm buying the call option, I have capped small losses, but I have potentially unlimited large gains. We can all agree to that, right? Now let's flip this on its head. If I'm buying the option, somebody's selling the option, and you flip it on its head, and that's what it looks like to the person who sold the option, right? I literally just took this in PowerPoint and flipped it over, okay? This is what it's like for that person who sold the option. They have capped small wins, and they have unlimited large losses. This sounds like the biggest recipe for all time to be the worst cake ever, right? I totally messed up that metaphor. Is what it is. Worst possible outcome ever are the outcomes that happen here, right? And I mentioned this before. For me, I lost over $200,000. Let me repeat that. This was not chump change. Over $200,000 thinking I was a genius by selling options. With an 84% win rate, thinking I was a genius selling options. And I lost money hand over fist year over year, thinking I was a genius in the process, okay? Because my losses were 6, 8, 10, 12 times as big as my wins. You will never mathematically ever come out ahead if your losses are 6, 8, 10, 12 times the size of your wins. It's never going to happen. So that is why we need to make sure we always follow the golden rule with leverage, which is never put yourself in a position to lose more than you can win ever. Now, I promised you guys some videos here. We all love to watch videos on this channel here. First one is about optionsellers.com. Is anybody here familiar with optionsellers.com? This is a juicy one. This one is so brutal. Like, you don't realize how brutal this is about to get. Okay. Let's go to this video here. I found 3 different videos to try and explain what happened in a couple different things, but let's watch this one first. I kind of skipped forward to the part where I wanted to start. Let me change the speed of it as well. Okay.
This is kind of how it's structured. And people who are selling options.
Okay, well, clearly my speed didn't change. I don't know about you, but my ADHD is so bad and out of control, I can't watch anything at 1x speed. Okay, back to this.
You see how much return he can make. It went to 100, say, all of a sudden that call option is worth $50. He's only paid $1 for it in that example. So this is kind of how it's structured. And people who are selling options, generally the probability of success is quite high for them. If they're selling, you can imagine if that call option is way out, if it's currently trading at $20 and you're selling a call option for $100, the chance of it going to $100 are slim. In which case the call option value will be low, but the probability of hitting it will be quite low too. So you can use it, some people call it for income, because they can sell call options, and it looks like you're creating income. Of course, there's a time when potentially that price does get there, something comes out of the blue and you're stung for a large, nasty loss, but people don't think about that very often. And this guy certainly didn't, because he was selling call options, like I said, believe, on natural gas, way out of the money call options. He was managing money for clients.
So optionsellers.com was managing money. They had their own little investment fund, and they were selling naked call options. Naked meaning there's no cap. Naked call options on natural gas. Okay, just for context here.
And so I believe he had 300 odd accounts under management, about 150 million. All of a sudden, natural gas did this. Here's the chart, guys. You can see how much it.
Here's the chart. Here's the chart. Dude sold naked options. I don't know where, but at this point, it exploded higher, right? And then it came back down. Now, what you see on this side here was about 2 months later. Woo! 2 months later, did it finally come back down?
it spiked up. Now, this basically effectively made these call options stupidly valuable and pretty much, not being around the bush, wiped out everybody's account. In other words, these call options he was selling to supposedly achieve income all of a sudden became very, very valuable, and he was on the short side of those in all his accounts. And of course, the brokers had to liquidate because all of a sudden the guy's on the hook for a massive amount of money that's not there. So these people lost everything. So the fund that he was managing, whether it was himself and everybody else, lost everything. Balances at zero, guys. Can you imagine that? Sticking money in and then balances are at zero, not even just a little haircut, zero. But that's not it.
But wait, it gets worse.
Because he was selling call options and it was each individual's account, those guys are now liable for debt that has been incurred from the unwinding of these call options. So as the price spiked up in natural gas, as we see here, the price spiked right up. They had to liquidate, get rid of them, and it left these clients with a massive bill to pay as well. And rumors are it's around $35 million left in debt, which they're trying to recover from each individual. So I saw...
So it was a $150 million fund selling naked options. And the options priced, or the options spiked up in price so hard that the brokers liquidated the positions on his behalf. Thanks, broker. You did a great service there. To the tune of $180 million plus. $150 million fund liquidated at $180 million. So now they're still trying to collect $30 plus million from the investors. Is that not a super effed up story? Isn't that crazy? That's breaking the golden rule right there.
A story, whether or not it's true, I don't know, of supposedly a retired couple had $1 million, put it in with this guy. They lost all of that, but not only that, they had a bill for 80K as well to say, hey, you need to pay because you're on the wrong side of this trade, and it's still 80K owed to the brokerage or to the exchange. Horrible, horrible, horrible. Right, so what can we learn from it, guys? The thing is, you know, if we look at the chart, and you look at natural gas and we go, okay, let's look at the chart from a long period of time. It's not...
Remember, all stocks are bad, including natural gas. That's a stock in this case. All stocks are bad, but every once in a while they act right. Okay? Every once in a while you catch a beautiful trend. But all of it is risky.
Not unusual. And before I kind of go down this alleyway, I don't want to say, no, told you so, told you so. That's not what this is about, guys. I know that accidents happen in trading. I know that some events happen. But let's just look at the chart and say, well, how often does natural gas spike up? Quite a lot. It's not unusual for it to exhibit these spikes out of nowhere, weather related, whatever it may be, and cause a problem. Now, that's...
And the crazy part about that is this happened at this spike right here. This blowout of this hedge fund happened on this itty bitty baby spike over here, not this big one. Absolutely crazy. And you know what happened next? What happened after that? One of the most embarrassing videos in finance of all time. Here's the dude managing the fund, complete with his Rolex Datejust right there. I remember whenever this came out, people trashing him. Like, bro, you are so tone deaf. You're making this apology video, sitting there in your nice suit, in your nice chair, in your nice office with your nice watch, and you're telling us, oh, wait a minute. Not only did I F up so bad that all of your investment's gone, but now you owe money. This is so painful to watch. So let's watch together. Let's Schadenfreude together on this.
Good afternoon. This is James Cordier of OptionSellers.com with a market and account update for November 16, 2018. Needless to say, the events of this past week have been incredibly devastating for our clients, who I rarely call clients, around the office, and sometimes on phone calls. I refer to our clients as family. And what we call a new account client call.
By the way, I'm running this at 1 1/4 speed, and it's still that painfully slow.
I often thanked and told the new client that we were so happy that you were joining our family. Dr. Steve, your wonderful wife in LA. I'm happy to share with you that Chris's ailments that we discussed so eloquently are going.
Anyway, let me skip forward. Let's see if I can find it. There's a point where he literally starts crying. Like that's how bad it was. He realized just how bad he effed up so hard. He lost all his money, all of his clients' money, and now they all owe money on top of that as well. It's brutal. It's so painful. I don't want to go through that. No way. I don't want to go through that, right? But that would never happen to you guys, right? Right? That would never happen to you. You guys are way smarter than that, right? Am I right? You guys are way smarter than this bozo.
Yeah.
Yeah, of course, right? But are you a Nobel Prize winner? Huh? You want to hear a story about how Nobel Prize winners even effed up so hard like that? Well, don't worry. I got one covered for you. This is a book which I haven't read yet, called When Genius Failed, the story of long-term capital management. And I actually going to pick that up and listen to it here in the next week or so. I'm very excited. I'm a nerd on finance history. And I didn't know that this book existed, so I'm very excited about it. But this is a book summary of long-term capital management called When Genius Failed.
What if I told you that some of the world's brightest financial minds, Nobel Prize winners, even, created a system so powerful, so calculated, that it almost guaranteed success, until it didn't? Picture this: a hedge fund so influential, its fall nearly brought down the global financial system. This is the story of When Genius Failed, Roger Lowenstein's captivating account of long-term capital management, a hedge fund that flew too close to the sun. It's a gripping tale of brilliance, arrogance, and ultimately, failure. A cautionary tale for anyone who believes the markets are predictable. In today's video, we'll dive deep into Lowenstein's masterpiece, breaking down each chapter to uncover how hubris, overconfidence, and blind faith in mathematical models led to one of the greatest financial collapses of our time. But first, don't forget to subscribe, like, and share this video.
Bro, don't forget to subscribe, like, and share this video. What are you guys waiting on? Do it already.
If you enjoy engaging summaries of timeless books. Let's get started. Setting the stage. The genius behind LTCM. Long-term capital management, LTCM, was no ordinary hedge fund. Founded in 1994 by John Meriwether, a legendary Wall Street bond trader, LTCM assembled a dream team of financial minds. Among them were Myron Scholes and Robert Merton, Nobel laureates celebrated for their groundbreaking work in finance. They
two, not one, but two Nobel Prize winners in this hedge fund. Like, they touted themselves as the smartest people in the world. Okay.
believed they had cracked the code of the financial markets with mathematical models that could calculate risks and predict returns with astonishing accuracy. Lowenstein opens the book by painting a picture of unshakable confidence. LTCM wasn't just any hedge fund. It was an institution built on the belief that genius could conquer chaos. Armed with their models, they believed that the market was rational, that risk could be contained, and that they were untouchable. But as we'll soon learn, no model can account for the unpredictable nature of human behavior or the complexities of global financial systems. Chapter 1. The Birth of an Empire. The first chapter takes us back to the early 1990s, when John Meriwether left Hang on,
I want to skip forward just a little bit here. Golden years. Arrogance takes hold. Let's skip to chapter 3.
As LTCM grew, so did its founders' arrogance. By the late 1990s, they were managing over $100 billion in borrowed capital, and their confidence was unshakable. They believed their models were infallible, and they dismissed critics who warned of potential risks. Lowenstein reveals how this overconfidence led to a dangerous feedback loop. The more they succeeded, the more they doubled down on risky strategies. This chapter also highlights a critical turning point. LTCM began taking on riskier bets, moving beyond their original strategy. They expanded into equity markets and emerging markets, areas far outside their expertise. Hubris had blinded them to the limits of their own knowledge. Chapter 4. The Beginning of the End. By 1998, the tides began to turn. In this chapter, Lowenstein masterfully builds tension as we watch the financial environment grow increasingly unstable. The Russian financial crisis was the first domino to fall. When Russia defaulted on its debt, global markets spiraled into chaos. Suddenly, LTCM's models, which relied on the assumption that markets would behave rationally, stopped working. Lowenstein details how LTCM's bets backfired spectacularly. Their highly leveraged positions, which once amplified gains, now amplified losses. The team, once seen as untouchable, was suddenly scrambling to survive. Chapter 5. The crisis unfolds. As the crisis deepened, LTCM's losses mounted. By the summer of 1998, the fund had lost nearly 50% of its capital. Lowenstein recounts how the firm's leadership remained in denial, clinging to their models and refusing to admit the scale of their failure. The irony, as Lowenstein points out, is that LTCM strategies were supposed to minimize risk, but in reality, they had concentrated it to catastrophic levels. This chapter is particularly gripping as Lowenstein describes the domino effect of LTCM's collapse. The firm's interconnectedness with major banks and financial institutions posed a systemic risk. If LTCM failed, the entire global financial system could unravel. Chapter 6. The mathematical model.
Let's go to the lessons learned in here real quick.
Could predict and control markets was fundamentally flawed. This chapter feels like a wake-up call, not just for Wall Street, but for anyone who underestimates the complexity of financial systems. Lowenstein warns that the same forces that led to LTCM's downfall, overconfidence, greed, and a blind faith in technology, remain pervasive in the financial world. Closing reflections. The story of LTCM is a modern-day tragedy, a cautionary tale of hubris and the dangers of overestimating our own intelligence. Roger Lowenstein's When Genius Failed is more than just a book about finance. It's a deeply human story about the limits of knowledge and the unpredictability of life.
Summary of that is long-term capital management thought they were so smart they couldn't fail. That they had figured out the market always behaves rationally, of course. And then all you got to do is just let it behave rationally and then collect your money, right? So both optionsellers.com and long-term capital management did something similar. They took the small gains and let the big losers work against them, right? And that's what we're going back to is the golden rule. You've got to make sure you can never lose more than you can win. And hopefully you lose a very small percentage of what you actually can win, right? That's how the math works in this game. So wanted to take a moment to watch those videos, right? And always remember that golden rule. Never put yourself in a position where you can lose more than you can win, ever. And options are the greatest trading vehicle of all time. So speaking of, we need to pause. We need to do some trading. And I need you guys to tell me, what we need to do. Right? At this point, you've learned enough where I feel really confident that you can tell me what we need to do. So who's leading the charge over here? Let's go, Joe. You tell me.
We need to roll MS. Whatever MS is, we got to get rid of it and bump it up. Morgan Stanley, I guess.
Let's double check a couple of them real quick. So every day I put out what my plan is for the day. Now, since we have 7 positions on, I wanted to take a time. I wanted to put out a pretty decent post in Discord about what I'm going to do. So you should have an idea of what we're looking at today. But do I need to do anything on Celsius? I mean, it's just the top of my list. That's why I wanted to ask. Do I need to do anything on Celsius? No?
No. Sit and hold.
What about, do I need to do anything on SMTC?
Nope.
Not yet.
Not yet. What about on Frog? I got to do anything on Frog?
No.
How about PayPal?
Nope.
Not yet.
Not yet. Okay, cool. So let's go to Morgan Stanley. What do I got to do over here?
That PayPal one is a great example of why you trade at the end of the day, because you would have been stopped out with that tail.
That's a perfect, man. I'm glad you brought that up, right? A lot of people, especially in our Discord, I feel like the people in our Discord, I love you guys. I'm so glad you're here, but y'all some like nervous people. Y'all nervous AF. Like if it ticks against you one penny, you're like, oh my God, it's crashing. I've seen so many of those posts, and it's like, bros, if you got a plan, just follow your plan. Just follow your plan. And so, yeah, to that point, right? I only trade at the end of the day. This is a good example why I only trade at the end of the day. I also don't put any sort of stops in the market because this is a great example of why you don't put stops in the market, right? So let's go back to Morgan Stanley. What do I got to do to this, guys?
No, it's not close enough. Nothing.
I don't know. You tell me. You don't think that's close enough?
Well, it didn't specifically cross.
I don't think that one or Celsius is ready to roll, but
Well, Celsius sure isn't. No. I mean, let's get really remove just that one. Okay. If I'm looking at Morgan Stanley, it's like
it's pennies.
I was saying in my note on here, where did I say it? I'll look to roll if it continues around 140. I would consider 139.69 about 140. You don't have to be specifically right on the penny on that spot where you're going to roll. You're just trying to make sure that it's done something, right? Compare Morgan Stanley's candle to PayPal's candle. That hasn't done anything yet, right? We don't have a real reason to roll this, where Morgan Stanley really has done quite a lot. Done a lot of movement here. In fact, it's up how much today? About 1.4%. Doesn't sound like a whole lot, but it's moved up close enough to that 1 ATR. We could look to roll it. Now, where in the wide world of sports do I need to roll that from, fellas? You tell me.
We were looking at 135 strike price.
Okay.
Because there's a lot of open interest, but we're back at, well, it's moved down even more to 67 delta.
Okay.
Is that too much?
Currently in the 130. When I look to roll, I just look around like, okay, where can I get filled? First off, where can I get filled is the question. There's the outlier effect, as usual, right? 8,000 contracts there. The next closest one is 3,000. So the 135 makes sense. We could roll from there to there.
Oh, I just locked up.
So the 134 has less extrinsic than the 135. So I was going back and forth on that. When I calculated it, the 134 was 28% extrinsic, and the 135 was 35% extrinsic.
Okay. The 35 really would be an elimination for me. But let's do the math right now, right? Both of those have at least 250 open interest. Now, if we go over here to the extrinsic value on the 134, that's $2.38. And then we divide that by the ask price, which is $8.10. That's 29% extrinsic value. And if we go on to the 135, that's 267 divided by 740. That's 36%. Yeah, for sure I would not take that one. Could we roll from the 130 to 134? Yeah, we could. It'd be a little expensive. So honestly, I think I would skip that one. And reason being is that I'm giving it a little bit of grace on this side, but then I'm also going to give it a little bit of grace on this side. It's like, how much room am I willing to give in my strategy, right? I can let one thing fudge or another, but I don't want to be fudging more than one thing, right? Because of that, I wouldn't roll that up. But that's me personally. If you guys feel like you need to roll it up, then go for it. Let's talk about the next one, KKR. Ooh, I think this one's going to be a different story. Now, my note from earlier said I'll look to roll if it closes around 132.40. KKR is currently at 132.16 and rising fast. So, what do you think we should do here? Should we hold it? Should we roll it?
I think we roll it to the 125.
Okay, let's go look at KKR. The Hammer Donkey says, I like fudge, but not that much fudge. Okay, so in KKR, we're in the 120s. All right, so rolling it to Dave, you said the 125?
Yeah, 125.
Okay, so let's look at that. So the 125 has 618 contracts, or open interest at least. Let's do the extrinsic value calculation. $1.83 on 9 is 20%. I like that a lot better already. And we're within a little bit, pretty close. We're within like 30 cents or so from that point. I actually am okay with rolling. I actually am okay with rolling KKR. That doesn't mean we won't do Morgan Stanley, but we're not doing it yet, right? We could revisit it in a few minutes if we want to. But KKR, I want to roll that one. So looking to roll KKR the 120s. So we'd buy to close. Let me do this as one order here. Buy to close, and then I'm sorry, sell to close, then buy to open. The 120s rolling up to the 125. I'm going to do that on my end as well. From the 120 to the 125. And looks like mid price is $4.15, give or take. $4.20. See where I can get filled. Filled at $4.20. Easy peasy. I need to do my other account real quick. Now this gives me capital that I can go trade with as well. Ooh, exciting. Roll from the 120 to the 125. Yeah. All right, see if I can get filled again at 420. Filled again at 420. Okay, so I've now rolled the 120 up to the 125, and I did it for a credit of $4.20. Let me come over here in the Discord. I'll put out that alert real quick. Where's my roll trade? And copy that one. And I need to reply to the original on KKR. And today is the 26th. Rolled that, KKR. 120 up to the 125 for $4.80. Currently trading at 132.04. Now, that gives me capital that I can work with. Now, I actually... Oh, I forgot to tag everybody. Now, actually, I need to see if I can put on another trade. Everyone. Cool. Apologize for having to pause our lesson, but this is part of the game. Now, how much capital do I have? Do I even have enough to do anything? A little bit. I don't think it's enough to put any trades on just yet, though. All right. Let's go back to this list real quick. Was there anything else that you guys saw that we need to do?
Nothing.
Nothing? Okay. Let's double check on Morgan Stanley. Let's run the 5-minute chart real quick, see if anything's changing. It's actually not moving in the direction we want to see to roll it, so I'm not even going to stress on it. Okay, I don't think I have enough for my position size in a new trade. So I did put out here that I will look to buy SMCI or ANET or Deutsche Bank. So let's go look at SMCI first, the 42 calls. SMCI, July 18th, 42 calls, around $8.15. How many would I need to trade? And how much cash do I have? No, I'd only be able to put on half of my size. Let me go to the next one. SMCI or ANET. Now here's the thing. I could put it on. Absolutely could. But if I don't have my right position size, then it's not going to be worth it to me. Does that make sense? ANET, 95 calls. All right. ANET, 95 calls, July 18th. How many would I need to get of those? Maybe. Do some math over here real quick. No, not quite enough. I got 70%-ish or so of that one. Let's go to the final one. It was Deutsche Bank. I mean, if we rolled Morgan Stanley, then we definitely would probably have enough. But that's okay. That's part of the game. Last one is Deutsche Bank. The July 18, 28 calls. 28 calls. Now, these are cheap ones here. $2.35. 235. Nah, I don't have enough. I don't have enough. I could put on a position in all of these, but it wouldn't be my right position size. So for me, I'm not going to be taking any new trades. We rolled up the one, and that's okay. I will tell you, I would have made a change if Morgan Stanley was trending up versus trending down closer to that 1 ATR versus further away from that ATR. Y'all follow what I'm saying here? Okay. So with that out of the way, we're done trading for the day. That's the only thing we had to do. So I appreciate you guys. You're doing great. I'm excited to do this alongside you. Now, let's get back to our lesson. Options are the greatest trading vehicle of all time. Why options? Why options? Okay. So this is Capital One. This is a screenshot I took earlier. How's Capital One looking? How's Capital One looking? Just curious. Looking great, right? Nothing to do. And on days like today, there was a Market Wizards quote. I forget who I heard it from. He said, the money is made in the sitting. Money's made in the sitting, right? When you see something like this and it doesn't have a reason to get out, doesn't have a reason to roll, the money is made in the sitting, okay? So looking at Capital One, nothing to do here. It was 210.49 at the moment. When I took the screenshot earlier, it was 210.71. Just for context here, we paid $15 per share for the 195 contract yesterday. When we put this on yesterday, it was $15, okay? That was when it was trading at 207.84. Now for context, when I took this screenshot, it was at 17.70 and the stock was at $210.71. The option gained 18% while the stock gained 1.3%. Huge difference here. That's the leverage we're talking about. The stock is up 1%. The options we bought are up 18%. Pretty cool, right? That's a great reason why you'd want to trade options. But what are the Greeks? How many of you have heard of the Greeks with options? Just in general, you've heard of the option Greeks. Okay, everybody's heard of the option Greeks. Now, what are the Greeks? Actually, I had to ask ChatGPT, why are these called Greeks? I don't know why they're called Greeks, but they're the price measurements of the options chain. And it was the Black Scholes model. The guys from long-term capital management, those guys invented the Greeks for the options chain. Isn't that crazy? I don't know how to spell sensitivities. Here we go. Those guys invented the Greeks. And it's to symbolize the different sensitivities in the options prices. So this is what the Black Scholes model looks like, right? So everybody take notes. Everybody get ready. There's going to be a pop quiz. I need you to explain this to me in just a minute, okay? No. In all seriousness, I have a great story about the Black Scholes option pricing model. If you've been following me for any amount of time, you've actually heard me tell this story. But I was working in capital finance, or not capital finance. I was working in corporate finance, and my boss at the time had a CFA designation. Raise your hand if you know what a CFA is. Okay, several of you guys. It's a CFA is probably the hardest certification you can get in finance, like by far. It is brutally intensive. Like I knew a lot of people that had it, and all of them said it ruined their lives. But anyway, incredibly smart dude, very intelligent dude, but also an asshole. And we were having a conversation one day. We're talking about trading options, and he goes, "Oh yeah, if you're so smart, tell me the Black Scholes pricing model." And I said, "First off, I don't know it. I'll tell you right off the top of my head, I don't know what the Black Scholes pricing model is, but I know how to make money with it. I don't want you to ever have to worry. I don't want you to lose one wink of sleep at night, because I can't do that. And yet I've made tons of money in the market," and that shut him down pretty hard. Right? It's one thing to be academic. It's another thing to put it into practice. Right? It's like a football player going on the football field and saying, "Explain to me how that ball spins, Mr. Quarterback, you." And Tom Brady's like, I don't know how it spins, but it sure spins really far into the end zone when I throw those touchdowns. Same thing here. You don't have to know the ins and outs of it, but you do need to know how to use it. Sounds crazy, but it just might work. So yeah, I don't know the formula, but I know how to make money using it. And you're going to learn that too. I promise you that. Now, here are the Greeks. There's probably more of them. They don't matter. These are the only ones that I really care about or have heard of, and half of them I don't care about at all anyway. So there's Delta, Gamma, Theta, Vega, and Rho. Okay? Now, Delta is the change in price of the option for every $1 change in the underlying stock price. And it also can be used to approximate the probability it will be in the money at expiration. This is the one I look at all the time. This is the only one that I really care about. And you guys have heard me talk about it endlessly. We talked about it just a few minutes ago. The delta of option. That is basically classifying it on the scale of the options chain. What delta is it? A 50 delta is always and will always forever be at the money, because it's a 50-50 probability it'll be in the money expiration or out of the money expiration. An 80 delta is always and will always be somewhere deep in the money, because that's the way the option prices work. A 20 delta always and will always ever be out of the money. Okay. Now, what does that look like? So delta over here, you can add to pretty much every broker platform. I have heard some broker platforms are easier to use than others. But if it didn't have delta on my platform, I wouldn't be using it, because that is so easy to just reference, right? I'm always looking at the 80 delta to start. Talking earlier, right? I might go to the 75. I might go to the 84, but it's always my ballpark. That's where I trade. Now, some people always trade at the money. Some people trade way out of the money. But this tells you on the scale of where this is on your options chain. Next is gamma. How much does the delta change for every $1 move in the underlying stock? So looking at gamma, right? These aren't the same. We can all agree that these are not the same. When you look at them, they're not the same. But why is this one all the way down at 60 and this one all the way up at 90? Well, it's been growing, and that gamma is how much it grows for every change in the dollar price of the stock. Okay, so here's an example that I like to use. Delta is how fast you're driving down the road. All right, let's say you're driving at 80 miles an hour on I-30 headed east. Okay, that is your speed. That is your delta. Gamma is how hard are you mashing the gas pedal to go from 80 to 85. How quickly are you going from 80 to 85? Are you just lightly tapping the gas pedal, or are you pushing that thing all the way to the floor? On my Tesla, it's still called the gas pedal. Just putting that out there. Okay. It's always called the gas pedal. Now, on Theta, right? Theta is a different Greek, and this is measuring our time decay. Our time decay. This is the uncertainty premium that we have to pay to buy the option. Okay. We can't avoid it. There is more uncertainty on an option that's 6 months out in the future than there is on an option that's 6 days in the future. Right, we can all agree to that, right? There's always going to be more uncertainty the more time there is. Okay. And that theta will be larger further out in time than it is closer in time. Now, theta, when we look at extrinsic value, we just calculated extrinsic value just a little bit ago. Nearly all of the extrinsic value is theta. Not all of it, but nearly all of it is theta. So let's look at a couple strikes on here. So this is the 195 call strike and the 212 call strike. 195 is in the money around the 83 delta. The 212 is out of the money at the 46 delta. Okay. Now, the theta between the two is very, very different, right? The extrinsic value here on the 195 is really low comparatively to the 212. Okay. There's a lot more uncertainty with this one. And because of that, the uncertainty is a lot higher. Like this one, they have a very good certainty that this one's going to be in the money at expiration because it's already in the money. It could literally do nothing and still be in the money. Whereas this one, price has to go up to at least 212 and it's at 210 at this time to be in the money. Now, there's no free lunch when trading options, right? There's no free lunch in this. Everybody loves the idea of trading options, but you're still going to pay theta. Okay. That is the cost of the lunch because there's no free lunch in options. That's your cost to pay to buy your lunch. Now, what does that look like? What does that look like? So I like to use this slide. I added a few more notes to this one to make it a little bit easier. But looking at these two options, here and here, the 195 and the 212. Remember, this would be the 195 right here. This would be the 212. This is the one that's in the money. This is the one that's out of the money. It's at the money / out of the money. On the 195, in this case, only 10% of it, $1.79 on 1770, is extrinsic value, the time value. Whereas this one here, every bit of this is time value since it's out of the money. Okay? So 100% of the 212 is time value. Only $1.79 of this one is extrinsic value. So how much is it going to decay? Because every day that goes by, the extrinsic value must always go to zero. I told y'all that before. The extrinsic value must go to zero on every stock, every option, every expiration, every time, no matter what. On this one that's out of the money, this is going to decay. It's 22 days to expiration. It's going to decay around 4.5% per day. So your investment is eroding by 4.5% per day that you own this. That's not cool, is it? And then we look at the in the money, and only $1.79 of that is extrinsic value, and that will only decay by 45 basis points, 0.45% decay per day. So that means the out of the money options decay 10 times more, at least 10 times more than the in the money options. Now that's a pretty advanced concept. But this is what I'm trying to get across here is that this is a lotto ticket when you buy out of the money, whereas this is a leveraged investment. Both of them will have theta decay. One of them, it will be negligible. You won't even notice it. One of them, you're going to feel it real fast, real quick, and it's going to be really hard. You guys have any questions on that topic? I know that's a deep topic there.
Yeah, there's a lot to unpack there, isn't it?
For sure. And that's why I said this is going to be the biggest lesson ever. Yeah, JC.
All right. So basically, you're paying for a reduced unknown, for a reduced gamble. So if you're in the money already, you have less chance of it going south. If you're in for the bargain, if you're in for the cheap for the cheap ticket, then the bargain on the other side, the risk on the other side is you're going to be taking a nosedive if things don't go your way.
Dude, that's a great way to describe it. You totally nailed it.
Okay, cool.
Totally nailed it. Everybody pay respects to JC in the chat. Everybody type JC in the chat. Way to go, dude. I love it.
It's the only thing that I have understood thus far. So don't get too happy.
You are killing it. I'm proud of you, man. All right, let's go to the next slide.
I'm gonna hang in there. I can tell you that right now.
Well,
quick question.
JC, right? This one costs more, right? The one that I'm buying costs more because it's more valuable, right? And it's more valuable. One of the reasons is it has tremendously less theta decay. Tremendously less. Very cool. I'm so proud
Chris,
of you.
We usually look at like 21 days out on the options we buy. So from your experience, and it's not labeled on the chart, but when you get close to 1 week, is that when it starts accelerating on you and you want to get out or roll up?
Well, on our investments here, it's pretty linear, right? It's pretty linear. The reason that I roll up at 1 week to expiration, I have a slide on it later, but the risk of it going out of the money and having zero value accelerates greatly. That's called your gamma risk. Okay, the gamma risk accelerates tremendously whenever you get closer to expiration. Because, for example, if we have a week left on Capital One Finance, let's say we have 2 days left on Capital One Finance. Capital One takes a nosedive, right? My leveraged investment just had a huge problem here because if it now is out of the money and it expires, it's worthless. So that is why I'm always rolling. If we get within a week, the Friday before the expiration, I'm rolling out to the next week at least, maybe longer. Or if I can't roll it out, I'll just close it. Right? It's okay. We need to maintain a risk first perspective here. And on that topic, we don't want to go into any sort of gamma radiation risk, right? We don't, this is not like the Hulk where gamma radiation risk is a good thing, right? And you get all like swole, right? Everybody thinks you would look weird that you're green, but you're like, it's cool, right? I've always wanted to be big and swole like JC, right? So I could be one of his fighters, I may look weird, but I'm jacked, right? We're not looking for that, right? Gamma risk is a bad thing in trading. It might be a great thing in the octagon, but not in trading. All right. Next Greek is called Vega. This is how much option prices will change based on the implied volatility rising. Now, of course, your next question is, well, what in the wide world of sports is implied volatility? I got you. Bam. Implied volatility is how big of a move, up or down, traders are expecting to happen, right? And this is a future expectation, and it is not based on historical volatility, okay? Now, this gets pumped up at big events, right? Any sort of catalyst event, earnings announcements, product announcements, CEO stepping down, things like that. Any sort of catalyst event is going to pump up the options prices because there's a lot of uncertainty on that, right? Like when Apple releases its phone every year, right? The last 4 years, they've been the same phone, with a different color, but yet a new and upgraded phone, right? And so the market has responded accordingly, pushing Apple's price down because it feels like they've stopped innovating. But when they're about to announce the next phone, those prices on the options are super high because who knows? Maybe this is the time where they release something super cool, right? I've still got an iPhone 13 Pro. I have itty bitty baby hands, so I can't use the Pro Max, right? Got to use a little phone over here, and it's great for me. And the iPhone 13 Pro is 94% the same as the iPhone 17 or whatever. So when it comes to the new phone announcements, there's going to be a lot of people like, okay, is something cool coming out, or is it just going to be the same old, same old? So that implied volatility gets pumped up. Now, this does have an impact on extrinsic value. Remember, I talked earlier that extrinsic value is mostly theta decay, but you've got your implied volatility that's baked into that, and that's with your Vega. You've got your theta in that, and we do have a little bit more, right? But don't stress on it. Don't stress on it. Implied volatility does have an impact on the extrinsic value, but you don't have to stress on it at all. Now, that sounds weird, but I'll show you what I mean. If implied volatility is high, the options are going to cost more. It's a fact. But if you know where on the options chain that you trade, and you know that you're only going to pay 20% or less extrinsic value, you're just going to move up a couple strikes. That's it. It doesn't change anything to my trading plan, at least. It literally doesn't change anything to my trading plan. If implied volatility is the highest it's been ever of all time, okay, I'll just go up the options chain until I reach a point where it's 20% or less extrinsic value. I'm good to go. It doesn't change anything in my style of trading. That's one of the benefits. Okay. But if you are buying out of the money options, you're going to pay hellaciously much for those. And you're going to be so far out of the money that it's never going to happen. So, two different perspectives here. Lotto tickets versus leveraged investments. Now, implied volatility crush. This is what Dave wanted us to mention in the last lesson. When the catalyst event is over, everyone already knows what's happening. That uncertainty is gone. So the implied volatility goes down. And those options can lose value very, very quickly. That's why we always want to minimize how much extrinsic value we're paying for. Remember, my goal is 20% or less. Sometimes I'll fudge that, maybe up to 30% if I'm feeling really good, but generally 20% or less. If I can get it for less, I'm very happy. And that's the part that always decays. So we want to minimize that. No matter what, every single time, minimize it. Row. Here's another Greek. It's row. Row your options chain, okay? How much option prices will change based on changes in interest rates? Nobody gives a flying monkey donkey. Like, I don't think anybody pays attention to row. Row is the redheaded stepchild of option Greeks. Nobody cares about it, right? It's the middle child that gets left behind at the soccer game because nobody checked to see if the middle child was in the back seat. Okay. Nobody cares about row. Row doesn't matter. Just forget about it, honestly. So what matters most? To me, it's delta and theta, because I already account for implied volatility by moving up the options chain. Randy, he never cared about row. Screw that guy. Row is the worst. I know what you're saying, Randy. So Vega, the implied volatility, doesn't matter to me because I move right up the options chain to what I want to see. What matters most is delta and theta. Delta, remember, is the change in price of the option for every $1 change in the underlying price, and theta is the time value. We want to maximize delta and minimize theta. At the end of the day, boiling it all the way down, maximize delta, minimizing theta. And we do that by picking the right option strike. So what option strike do we pick, right? You've heard me talk about the 80 delta, give or take. You've heard me talk about extrinsic value. Andrew's like, what in the wide world of sports does 20% extrinsic value even mean? I got you, Andrew. You're in the right place. Do me a favor, Andrew. Tell everybody you know. So whenever I get to my slide for picking my my option that I go with, this is my slide, straight out of my trading plan. Forget about this. Forget about this. We're only going to focus on this, the option chain liquidity. It's not just liquidity, right? It's not just liquidity. It's actually putting us in the right spot on the options chain. I always start at 21 days to expiration. Why 21 days? Because most of my trades are 1 to 2 weeks. I give them enough time to work. Right? If I'm buying a 0 DTE option, a 0 day till expiration option, it has no time to work. It's either Lambos or food stamps. I don't play that game. No way. But if I go 210 days to expiration, then I have to overpay like no one's business on that. Remember, we talked earlier, a lot more uncertainty. So I have to pay a lot more for the option. Or my sweet spot's 21 days. 21 days. I like to see at least 250 on an open interest. And that is something, I have a slide for that in just a minute, that we are exploring at the moment. The outlier effect is real, and we're still trying to comprehend what that means, okay? Then there's less than 50 cent bid-ask spread. Let me see if I have a... Let me see, hold tight real quick. I want to make sure if I do or do not have a slide on that. I do. Okay, we'll come back. Less than 50 cent bid-ask spread. And then 20% or less extrinsic value. That's our uncertainty value. That's this value in the options chain, the extrinsic value. We talked in the last class about how to calculate it, but let's do it again real quick. Let's do it again real quick. On this one here, let's go with this one. So this is Deutsche Bank. This is the 28 strike. How do we calculate the extrinsic value? You subtract the current price minus the price of the stock. So the current price is $29.95 minus 28 on the strike price. Okay, that leaves us $1.95. But wait, the option is not priced at $1.95. It's priced at $2.40. All right. So take the difference in that. 2.4 gives you 45 cents. There's a little bit of rounding going on, but we're right there at 40 cents. That's your extrinsic value. This is the time value. This is the amount that will decay to zero on every option, on every strike, on every underlying, on everything. It always goes to zero at expiration. In fact, let's do this. This will be fun. Let's go to SPY. What I want to do is look at the extrinsic value on this one that just expired today. Okay. So this one that we're looking at has extrinsic value of $8 that expires in 22 days. If we come up to 10 days, remember 861 down to 488 because there's less uncertainty. And then we come all the way to 0 days to expiration. There's no extrinsic value. Don't worry about those negatives. It's like in Wizard of Oz. Don't worry about the man behind the curtain. Okay. Those are supposed to be zeros. There's no extrinsic value left. You go out 1 day, there is some extrinsic value here. You go to today, there's no extrinsic value. So 20% or less extrinsic value. This is why I say Vega and implied volatility, they don't matter. They don't matter. All I have to do is just go further up the options chain to find one that has my percent of extrinsic value, extrinsic divided by the ask price, and then that's what I get. I'll have to go up further if there's higher implied volatility, but it's fine. I'll still go up further. Not a big deal. It's not going to kick me out. Usually around the 80 delta is where I go. Now, here's the deal. You can trade any option you want, or you can decide you don't want to trade options at all. That's up to you, right? And the choices are nearly limitless whenever it comes to which option you want to take. So just pick what works best for you and your style of trading, right? I'm going to give you everything that I do, but even though I worked with 5 of the market wizards, I don't do every single thing that any of them do. I do some of the things that some of them do and some of the things they don't do. So pick what works best for you. Now, liquidity. We're learning right now that the market can absorb pretty much anything we want, right? My rule of thumb had always been go 4 to 6x how many number of contracts you need. So generally my rule of thumb is around 250 or greater. But thanks to Dave being as eagle-eyed and brilliant as he is, and handsome, what I found is that the market can basically absorb everything we want. Thousands and thousands of contracts that all the outliers are trading along with us are getting put into the market without an issue. I'm really excited about that. Like, I'm really excited about that, Dave. That makes me wonder, where is that lowest limit threshold? I don't know if I want to test that lowest limit threshold is the thing, right? I don't want to get to a point where there is no liquidity. What do you think, man?
I worry about the exit.
Yeah.
I'm not worried about the entry. I think we can get a clean entry, most days. The exit worries me a little bit from that point of view, because I do see that the bid-ask spreads get a lot wider. We saw that on several of them today. That's where I have my worry. Again, not worried about getting in, but getting out is where it really matters.
Yeah, for sure. Big Dino says, I feel bad for option sellers. Me too. But there are plenty of scammers on YouTube who will tell you how amazing it is to sell options, and they got me. Mm-hmm. I mean, they honestly did. And there's this one guy who I had seen him before in a different niche, talking about entrepreneurship and things like that, back as I'm building businesses. And now that same dude is now selling, this is how you make money selling options. And I'm like, oh shit, he has no idea. This is not his lane. He's going to get blown up. He's going to take a lot of people with him because he's a great salesman, and it's going to be brutal. So it's going to be like optionsellers.com all over again. That scares me. And, I hope it scares you guys here in the class, and also everybody in the chat. The way that you can make sure that doesn't happen to you or someone you love is by telling more people. Option selling is a scary game. Don't do it. It breaks the golden rule of leverage. What's up, Joe?
So a few weeks ago when we were trading, I was trying to figure out during the day what may be the appropriate pick in terms of the expiration date and strike, right? And you actually picked one at a closer expiration date. Instead of 21, 22, whatever it was, you went down to 16-ish or something. And I couldn't figure out why you did that. So I'm asking, did you do that because the extrinsic was higher out at 21 and lower in at 16 or whatever it was?
That's a great question. I failed to address that. So let's go to like Morgan Stanley, since we're in that right now. So I would start here at the 21 days to expiration. And then my eye goes over to how much open interest do I see? Here, no problem. That's us right there, the 8,500. Easy peasy. But let's say it's all like 20, 10, 16, 34. There's no liquidity. I'll go one sooner. I'll say, okay, not really all that much liquidity here either. I mean, this one's okay. And then I'll look over and I'll calculate my extrinsic on my my price. And so if we went for this one, $1.38 on 620. And if that doesn't work for me and I can't find anything else, then I'll go one opposite. So starting at 21 days, going one sooner, then going one later, and I'll look there for liquidity. Like this one, I would just avoid. And then once I get to a strike where I can see, okay, I've got liquidity to get in, hopefully enough liquidity to get out, that's when I start pricing the extrinsic value. For sure. For sure.
Okay, thanks.
JC's out. See you, bro. All right. So we're nearly done here. Let's push through. Let's bring it home. But make sure that whatever one you pick has a tight bid-ask spread. The tighter, the better. So I wanted to pull this example because it's really interesting. It has very wide and very tight, right? Here is 30 cents. Here is 40 cents. Here is 50 cents. Here is 30 cents. Here's 50 cents. Here's 50 cents. Here's $1. Here's 60 cents. Here's $1.40, $1.20. Here is 80 cents. Here's basically $2 plus, right? All in the same options chain, okay? All in the same place. You've got liquidity spread all over the place. When I look to put on a trade, always remember, you can get in here and get out here. You're going to get filled at those prices. But the difference between the two is how much the market maker is taking home. Mikey Mike, the market maker, is over here stealing everybody's money from the time they buy it to the time they sell it. Okay? So Mikey Mike, the market maker, is doing his job by providing liquidity And that's where he's going to get paid, is on that spread. So we want to pay Mikey Mike, the market maker, as little as we possibly can. So speaking of Mikey Mike, the market maker, I need to say something to you, Mikey Mike. I really appreciate you.
All right.
I really appreciate you.
Someone's in
Mikey
trouble
Mike
with
sent
teaching.
something in the mail yesterday. I had a chance to start looking at it, and I want you to know that was super heartfelt. I let my wife check it out as well. That was really cool of you. I don't want to bring a lot of attention to it, but you are awesome, dude. I really appreciate that. That's cool of you.
I appreciate it.
So going over to Skew.
Sounds like we're putting hashtag Mike in the chat. Isn't that what I heard?
Hashtag Mikey Mike. I like that. Hashtag Mike in the chat. Hashtag Mike. Typing in hashtag Mikey Mike, the market maker, is far too much to type. So we'll just put in hashtag Mike.
MMTMM.
Okay. Hashtag Mikey Mark, the market maker. MMTMM.
Sorry.
All right. So back to this. We're almost done, I promise. We're talking about Skew. You may have heard of that before, but fear is asymmetrical in options. The same delta call versus the same delta put, they're going to have different prices. So let's see what that looks like here. A 32 delta call, out of the money here, 32 delta call costs $2.80. A 32 delta put costs $3.10. See if I can make this bigger. The 32 delta call cost $2.80. The 32 delta put cost $3.10. Okay. And then a lot of that is people's portfolio insurance, or their hedging. I'm telling you right now, if you think you're a genius by hedging, it's just a huge waste of money. Hedging is buying something that goes up in value as your main investment goes down. A lot of people do this by buying puts against the stock that they've already owned, right? Let's say you own 200 shares of Apple. You go out and you buy 2 puts on Apple. Why would you do that? You're sacrificing gains in both directions. The put's going to lose money as Apple's going up. The calls are going to lose money as Apple's going down. It's stupid. Just don't do it. If it's not working, just get out. You're actually trying to lose money in both directions by hedging. What's up, Paul?
I was listening to a podcast today, and there was a couple of hedge fund managers on there talking about, and they were swing traders or trend followers, and they were talking about the trending stocks will always, they're going to drop eventually, and they were actually shorting to hedge against that possibility. And I was just, they said, well, you can sell it or you can hedge it. So I was surprised they were hedging.
Well, to that point, you could sell it or hedge it. Maybe they have a mandate of some kind that they have to keep X number of dollars in. And so the only way that they can keep those dollars in is to have a hedge against it. I think in my personal humble opinion, what do I know, is hedging is a dumb thing to do. If it's not working, just get out. I don't want to lose money on the puts by buying stock. I don't want to lose money on my puts by having them work against my stock. It's so dumb. I mean, your overall net profit is lower in both outcomes. Okay, let's keep going here. Now, we're going to talk about rolling. I mean, I told you guys this is going to be a big one today. We're still going here. Rolling, like we did earlier. So let's take a moment here and talk about KKR. How did Morgan Stanley do, by the way? Oh, Morgan Stanley made it up some, but that's okay. KKR, we rolled. And by doing so, we bought as one order. We moved from the 120 to the 125, right? When it moved approximately 1 ATR in our direction. And we did this for a credit. Here's the deal. If you cannot do it for a credit, you're doing it wrong. If you put your trade in and it says 20 cents in debit, you've done something wrong. Stop what you're doing, clear the order, and start over. Kind of like what Paul, did you get your order that you wanted earlier before we started?
Which one was that? Morgan Stanley or KKR? I ended up getting the
earlier. It was coming through as 2 different orders, and you weren't sure.
Yeah, I was able to cancel both legs with one click.
Okay, good. Yeah, and that's the deal, is that you want to do this as one trade, right? There are people who may, because of broker reasons, have to close one and then open the other. That's not going to help you. Oh, Joe. Okay.
Yeah,
when you
so
do that,
I've got to remember what I paid for it, and then notice what I'm gonna pay for it, and then,
you're also losing money on the slippage too, man. Because when you roll, you probably can hit right in that mid spot, but because you're having to sell one and then buy back the other, you're giving Mikey Mike, the market maker, all the monies. Right? I mean, he's happy about it, but you, on the other hand, you're getting hosed in that case. That's not cool.
Yeah. I love you. I love you, Joe.
Do you have much luck going for the mid price instead of the bid or the ask?
Oh yeah,
because I tried that twice today and it didn't work.
Oh yeah, dude, it's way easier to do because you've got both sides of the trade. It's when you get all the way on one side or all the way on the other, Mikey Mike, the market maker, is like, well, I'm gonna take this guy to the house. But because Mike's making spread on both sides, he can give it to you at a better price in the middle. But as one order, sell to close the original and buy closer to the money for the same number of contracts, but you got to make sure you keep your liquidity standards. And it's actually pretty cool that we got to do this earlier in this video as well. And when you do that, as you saw me earlier, right, that gives me partial profits now. Not full profits, but partial, right? Taking money off the table. It frees up capital to trade with now. As you saw, I was looking for new trades. And it wasn't enough for me to put on a new position just in size yet, but that's okay. But it kept my trade alive. I took money out of the market today. That's my money. Nobody can take that money from me from now on. I can put it in my bank account. I can withdraw it. I can do whatever I want with it. And that trade's still going. How cool is that? How cool is that? I kept the trade on, yet I took partial profits off. And then after you do that, be sure you raise up your half ATR exit to the new point, right? So let's go to that real quick. KKR. In fact, let me draw my little lines on here. Bullish ATR levels. There we go. And so my half ATR now needs to be up here. And then I'll put
MS hit the 1 ATR right at close.
Very cool. Yeah. Let me put on here rolled. So just like that, right? Now my stop out point, I move from down here to, in theory, have locked in gains. Right now, of course, it can gap down, it can push through that, everything can happen like that. But in theory, if I got out right here, I've just guaranteed gains on this. Pretty sweet, right? Okay, let's keep going. Next is rolling out. It's the same thing as rolling up, but instead of going from the 120 to 125, you'd be looking to go from maybe the 120 to 120 on your current one. Let's say if it's 21 days on the first one, going out to maybe 28 days, maybe 35 days, something like that. You're looking to go out because you need more time for it to work. But usually if you're rolling on the same strike, you're not going to be able to do it for a credit. But if you roll up and out, you should be good to go. You should still be able to find, you won't have as much credit as you would rolling in the same expiration. But if you roll up and out, there should be enough credit to still push a credit through. It might be really small. It might just be a nickel. But anytime you do it for a debit, you are you're taking an additional risk. Anytime you do it for a credit, you're taking money off the table, you're taking risk off the table, you're making less risk in the trade. It's the best thing to do. So rolling up and rolling out. So for example, I made this one earlier before we'd actually did one live, but you would sell to close the 195 here or 1710. Right? Remember, Mikey's got to make his money over here. And I buy the 202.50 or 1140, and that gives you a credit of $5.40 to move up from the 195 to the 202. And like I say, if you see it for a debit, you did something wrong, you need to stop, reset that trade, and figure out where you went wrong so you do it right the next time. We have finally gotten through it. Okay, Mike.
Since the chat's not working on the side here, somebody's got their mic on. There's dishes clanging and all that.
It's probably Paul.
Way to go, Paul.
Paul's standing at his kitchen sink with his little earbuds in, and he's washing dishes while no one's looking. Okay, cool. Here's your homework. Now listen, you got 2 weeks to do this homework. It shouldn't be too hard. Next week, no class on Thursday. No class on Tuesday. We're just going to vibe out on Tuesday. We're going to have a good old AlphaU hang. It'll be great. This will be like when you were in college and you were going to the college bar and you happen to see your professor there. You're like, "What's up, Mr. Yule? How you doing?" Right? And you dab him up and you hug him and everything. And you're like, "Hey man, can I buy you a drink?" And he's like, "Yeah, sure, why not?" That's what it's going to be next Tuesday. We're going to hang out. It's going to be great. I mean, even if you showed up with a couple of pre-drinks to make it fun, that'd be cool too. But come up with 3 option strikes that you would buy. Right. And I don't want them to be the ones that we did in the trading room. I want them to be independent on your own. Okay. And take screenshots and tell me why you would want to buy these. But don't look at any charts. This is not about trend trading. This is about making sure you know when you're looking at an options chain what to look for. Right. And I want to see them. I want you to come to the next class and show me the screenshots. Like, hey, this, and this are the ones that I would trade. And this is why I would, right? Like legitimately, it can be 3 random ass stocks. I don't care. Does not need to be in a good trend. We're only focusing on the chain itself. And then I want you to find 3 that you would never trade. You wouldn't buy that with my money, right? That's how much you wouldn't buy it. And then bring those. I would love to see these because these are going to make some really great examples that we can use for how to trade on an options chain. So, oh, you know what? Eric had a question. How much is Outlier? I love the softballs are so fun. Well, since you asked, Eric, Outlier is only 82 cents a day, and it has a full money back guarantee on Outlier University. Outlier University, if you're not satisfied with Outlier University, you get a free money back guarantee. But Outlier, the software itself, is only 82 cents a day if you take the annual pass. And if you're on the monthly plan, you can upgrade and save 64% off the regular monthly price with just one click. So that's a great question. All right. What questions do you guys here have in class? And for those of you who are watching, do me a favor and put a hashtag Q and then type your question. And I'll try to answer as many of those as we can. So what's on your guys' mind? How can I help you?
For me,
Mike.
And when you enter these things, and maybe this isn't the place. When you enter this roll up in the manager sheet that we use, do you show that as 2 start to a trade and end to a trade, and a start to another trade, and then when you close the roll, or how would you? That's what I did on the last one.
So I do it as one order, and the reason that I do that is it makes life way easier, right? So let's say on who do we roll? KKR. Go into your KKR, and that first column where you put your price, that's the original price you entered with. In the second column.
I'm sorry. I mean, after you've done the roll, the sheet that we record all our moves in, the one you created, I think.
Yeah.
Okay.
Yeah. So you're going to stay on that one line. You're going to stay on the one KKR line. You're going to go over into the column where you put in your closing price. Go ahead and put your roll in right there. Go ahead and put it in now. And it's going to look tiny compared to what it is, right? Then add the value of the option you currently own. So if you rolled it for 420, I think?
Yeah.
Yeah, we rolled it for 420. And then KKR, so 125. So KKR. Hold on. So you'd put 420 as the credit that you just took in. And then the 125, you would then add on top of that. So then you would say 420 plus 980 or 950 or whatever you want to put it at. That would be the current ending price of it. Now, of course, we're not closing it today, but that's going to keep your ROI in check. That's going to actually show you your total ROI on the trade as it continues to grow.
Okay. All right. Awesome.
Yeah. And then whenever it does all of your metrics and stuff, it'll just record it as one winning trade versus 2 winning trades or 1 winning trade and 1 losing trade, because it is 1 winning trade overall at that point. Does that make sense?
Yeah. Okay. Awesome.
You're awesome, Mike. Jeez, give me a break. Amy had a question. I know the market is closed, but what would you have done with Twilio? I didn't own Twilio. I wouldn't have rolled it. Let's take a look at Twilio. That was one I was looking at yesterday. I remember. I don't remember why I didn't get it. Let's see. So Twilio right here. I mean, right now it's currently sitting at 121.43. The automatic projection of the ATRs is put on there already. So that would be my stop out point. It's 119.67. I assume maybe you got in here and it's up to this point. I mean, Twilio's ATR is pretty huge. It's $3.48. $3.48. So it's nowhere close to rolling at this point. I mean, from, I imagine if you got in yesterday at the close, it'd still have to go up $5 to reach that point from today. Or even if it went up $3.48, it'd still need to go up further to roll it to about 123. Then let's look at the Twilio options chain, TWLO. This is the July 18th. I mean, it's got tons of liquidity here at the 110. It's got tons of liquidity at the 115. So I mean, if you really felt like a deep compassion to roll it, you could take in maybe 395 in credit, give or take. But I don't have Twilio, so I don't have any horse in that race. Joe's has a question. Thank you for all you do, Chris. That is the weirdest question I've ever heard. Almost sounded like a statement. You're welcome, Joe. Mr. Dave, not that Dave, sorry, he wasn't talking about you. If the return is good, what's the detriment to rolling up earlier than 1 ATR aside from commissions? So that's a great question, right? And that's what we're talking about earlier today. It's really a guideline. It tells us where something has happened enough to justify that, right? And so when we were looking at the two trades of PayPal, where nothing's happened, we don't really have a reason to roll at this point. Versus, let me take these off. Versus KKR, where something definitely happened at this point already. So that gives us a reason to roll. And then Morgan Stanley, almost there, not quite. Then you could look at another one like the Frog over here, right? I'm definitely not rolling that one because I'm not profitable on this. And the roll here, it's an offensive move because you can take money out and now go trade something else, but it's also a defensive move because it takes risk off the table. It is such a win-win situation. I love it. It's so cool. Okay. Big Dino said, when setting up the ATR lines and when rolling, do you move your ATR lines up to the new strike? The only ATR line I move up, like I did a minute ago, is the half ATR stop out point. Other than that, no, I don't move anything. We just talked about that catchy handle. Mike was asking, good one. Steven was replying to someone, I think. Chris closes if the price closes below his stop loss. Exactly. No automatic stops, and I don't want to get wicked out of a trade. Precisely. Yeah, that's exactly what would have happened in PayPal today had I had an automatic stop. Steve, will you do a YouTube short on the position or the portfolio spreadsheet? Probably at some point I will. I'm sure of that. One thing that we're doing, if you go over to my channel and go to shorts, I've tried to make a short for every step of the trading strategy to help you out with that, right? And like I have to be really concise when I only have 60 seconds.
Now you just said you don't increase your, it'd be the 2 ATR once you've rolled. You don't increase the 2 ATR because you still want to use that as a trigger to roll again.
Yeah, great point, Joe, for sure. Let's see. Looking for any other questions. I have a moment to answer without spending another year doing this. Let's see. Okay. Byron Jesus or Byron Jesus. Byron Jesus, I'm glad you're here. Byron Jesus, you as well. Do you have to keep the strike when rolling? Well, you're rolling off of one strike and onto a different one. So you're definitely not keeping the strike. And if you're going out in the future, it's super unlikely that you could keep the same strike going out in time. And because of that, you're probably going to have to roll up as well as out. All right, Turtle Chris is going to be the final question. Only because he did equal sign, and I appreciate that. Why would you not consider the spread as a percentage rather than an absolute 50 cents? I don't know, just rule of thumb. Just rule of thumb, right? I mean, listen, I would much rather not have to pay Mikey Mike anything. Screw that guy. I don't want him taking my money all day, every day. But what a good thing he's muted. I'm sure he's cursing me to death right now. But I don't want to pay him anything. I feel like he's about to retort.
A tapestry of obscenities.
Very elegant obscenities in that case. Yeah. As far as like the bid and ask spread, could you apply a percentage to it? Absolutely. And I would recommend, if that's something that's important to you, add that to your trading plan. You know, my trading plan is not the be all end all, but I am going to teach you everything be all end all that I know. And also, listen, I think Dave has something on his mind.
I was just going to say, Chris, I actually do run this, and I just put in for Thinkorswim. I've got a custom script that I throw in there, and it's a quick glance, gives me a simple percentage of what that looks like, so I can tell, is it getting extreme? Works really well, but I just put it in the Thinkorswim tab in the Discord for everybody.
Oh, cool. What a rock star. Thanks, Dave. Now, listen, all of you guys who are watching right now, you're all rock stars too. And you know what rock stars do? They save time, make money, and start winning with less risk by clicking one of these 2 videos. You guys help me point out the 2 videos. One's going to be over here, and one's going to be over there. Very perfect. You guys have a fantastic day. We'll talk soon.